challenge, I think, really has been with the efficiency of our economy in being able to absorb stimulus packages of this kind. I think the problem with the stimulus package in itself, it doesn't always address all the what's ailing our economy. And I think there's a general concern that it's not just about the availability of credit. And I think looking in the capital markets at least, I think what we're seeing is a continued lack of confidence that's contributed to a fairly depressed environment. And I don't think a stimulus package in itself is likely to sort that out. So I think what we're looking for is a slightly broader based approach to addressing the ills of our market, which largely stem from a combination of factors that were global in part as well as local. And I think the challenge we're having at the moment is that there is no solution that seems to be addressing all the different aspects of the general gloom that has dominated our market for quite a while now. And I think it's what continues to be a weight on our market. And it's until we look at that, we're unlikely to be able to mount a significant recovery.
So given that that's the case, I mean, what's your view on where this market is headed in the short term?
I think in the short term, I think many of us, in fact, have stopped looking at the short term because the short term doesn't really hold out much promise. But we're finding that for institutions and individuals, particularly in the stock market, who are able to adopt a much longer term approach and view of the market, there are quite a few bargains to be had. But certainly when you talk about recovery, everybody's anxious to see that recovery come quickly. And I think that's the conflict we have in our market at the moment, because certainly in the short term, even if you look at the performance of the Nairobi Stock Exchange and the index, we've seen that short-term runs have been quite unsustainable. And yet there still is a long-term proposition for investors who are able to look past a 2 to 3 year horizon in terms of their investment horizon. So I think the short term, there's not too much to say about it other than to say it's going to require resilience and staying power. So it's not really about the short term, it's about the ability to stay with the market into the long term. And that is a challenge, I think, for many investors.
Before we continue with this discussion with both of our guests, let's recap first on the performance that was put on by the markets in yesterday's trading session. We had the NSE 20 index shedding just over 7.5 points to finish at just over the 2,969 point mark, with turnover for the day coming in at over 157 million shillings. Foreign investors participated largely in the buying side of the day's main movers. Blue chips and other value-based counters continue to become the securities of choice as the weekend draws near. We had the three major contributors to the day's turnover being Safaricom, Equity and Access, accounting for a large percentage of the total turnover. We had Safaricom holding steady at between the 370, 375 level for the day, moving the most shares as supply remained imminent at 3 shillings 85 for over 4 million shares. Foreign participation accounted for virtually all of the purchases for the session. And as we move through the week, the security is expected to maintain these levels, still supported by foreigners. In the meantime, we had Access shares experiencing improved foreign participation as well, as they were mopped up at between 1940 and 1950 shillings. The security is expected to register significant exchange of volumes as it continues to attract both speculators and long-term investors. And the shilling, in the meantime, seen trading in a pretty tight range of between 74.75 and 75.75, so still within that band against the dollar in coming days on imported demand for greenbacks and central bank purchases, which have been matched by agricultural and aid agency inflow. So we've got that unit coming into today at 75 shillings 17, so staying pretty steady still. Remember, last week we saw some offshore inflows of dollars from investors looking to put money into Kenya's corporate bonds. On the other hand, the central bank has also bought dollars in a total of $16 million on both Tuesday and Wednesday. So we're seeing balanced trading here. So Leon, on account of that, I mean, we know that foreigners have been very busy on the equity side of things. This at a time when we've had a local segment of the market looking keenly to the bond side. Let's look at foreign investor interest in the fixed income market, because there's a strong distinction that needs to be made between the activity we've noted on the corporate bond front and then government bond front, right?
Correct. I mean, in the latest bulletin that we saw out of the central bank, we see that foreigners own less than 0.5% of the domestic government debt. Right, it's tiny. And in fact, if anything, we've seen over the last year is decline from just over $3 billion to about 2.4 billion shilling to 2.4 billion shilling. Tiny. So we've actually seen a decline, and private sector flows in terms of the balance of payments has in fact been negative over the last year. So, but once you go into the corporate space, and I keenly wait to see the results of the Kengen bond offering to see how much of that was taken up by foreigners. I suspect not a huge amount. Safaricom, though, it's a much better known name. I think we might see some interest, and that closes at the end of the month. So maybe we will see some money coming in into the market for that.
Let's get Kingori's perspective there. Kingori, what are you anticipating out of those results for both the Kengen and Safaricom bond issues?
I think we're already hearing a lot about the Kenyan bond likely to be oversubscribed, actually to the tune of its 25 billion, including the green shoe option. And I think I would agree that you're likely to see a lot of foreign participation. And that's been a challenge for us because as a market, we've been looking to attract foreign participation, but it was always a desire to match that with local participation. I think at the moment we're seeing a bias in favor of foreign participation, which is to be expected because we have more sophisticated foreign investors who are likely to be able to look at the fundamentals of the market rather than its temporary condition, while most local investors, unfortunately, have been looking at its temporary condition and unable to take bets on the market, which is likely to lead to a distortion in the future. And I think we're all curious to see just how much that distortion is likely to affect trading going forward.